Another day and another win for the bulls. Markets got the data they wanted. Yields fell and the broad market put on a show. The S&P 500 gained 0.8% today to cap off what was a very bullish May. So with May behind us and June in front of us and the inflation data now supporting the bull case, what normally comes next and what sectors will reap the most reward? Today, we're going to discuss that as well as June seasonality, the consumer, as well as Goldman's expectations for the rest of 2024. What they have to say might surprise you. So are they bullish or do they see more downside ahead? We've got a lot to talk about, so let's roll the tape. Welcome everybody to the daily recap show where we talk about stocks and the financial markets. My name is Chase. If you like this video, please subscribe, hit that notification bell, like this video and leave a comment for the algorithm. Let's get into it. All right, looking at the daily heat map of the S&P 500 and what a day for the bulls. Very, very green across the board. I mean, Amazon didn't participate, neither did Tesla, and so didn't semiconductors. Other than that, it was a fairly positive day across the board. We saw software bounce back, the Salesforce up 7% after terrific earnings, and some of the other names did follow. ServiceNow, Uber, as well as Intuit up 2.39%. So a bit of a bounce in software. So maybe the market looking at these names and saying, hey, if you're going to fall 18%, I'm going to buy because that's a really attractive price. But we saw exceptional bullish momentum across the board, but it wasn't without volatility. So we got the PCE numbers today. That was part of the reason why markets were upbeat, but we got the PCE numbers pre the market open, and you could see almost every single sector here within the first hour of trade was pretty positive on the day. Then actually most of these sectors went negative, as you can see, and that actually had to do with the Chicago Purchasing Index. After we got the purchasing index numbers, a lot of those stocks fell, but it was very short-lived because yields were moving lower. Investors and traders did put more weight on the PCE figures, and then we actually saw quite a rally from the lows sort of here at midday. A number of sectors all going from negative to positive, with the only negative sectors being GDX, gold miners, as well as semiconductors. Technology was pretty much flat for the day, and then from there we had a huge jump up into the discretionary space, up nearly 0.5%, then the XME up 0.81%, the SPY returning 0.91%, and every other sector beating the SPY. The best performing sector was energy, up 2.49%. I think there's also a bit of buying going on with the OPEC weekend meeting happening. Maybe we're going to get production cuts. I'm not too sure on the news, but very bullish action there on a day when other commodity sectors like XME, like GDX didn't quite produce the same results. We saw rate sensitive sectors really perform well today. I mean, look at stuff like XLE, XLU, ITB, XLF. Now you might be asking, XLU is a defensive sector, not a rate sensitive sector, but you have to understand that names like utilities, staples, home construction, and financials, right? They benefit from rates, not just because of their business model, but a lot of these stocks have a ton of debt on their balance sheets. And if rates are going to come down, that's just going to help them in general. But the only discernible trend here was that like rate sensitive sectors outperformed and they were favored ahead of growth. Now let's actually talk about what moved the market here today. And it had to do with this right here. The month-over-month core PCE number, our expectation was 0.3%. We got 0.2%. So a slightly cooler than expected number, but every other print for the PCE came in line. The year-over-year figure was 2.8, the consensus was 2.8, and then the headline numbers 0.3 and 2.7 month-over-month, and the actual year-over-year figure. We also saw personal income came in line, 0.3. Personal spending came in a little bit cooler than expected, and then this is what caused the volatility intraday. Chicago Purchasing Managers Index. The number came in at 35.4, but the consensus was 41, so it was a huge miss. But the market put far more weight on the PCE numbers that did bring yields down, and that's why we rallied into the close. Now every index and subsector gained on the back of the PCE data and yields falling. We saw the S&P 500 was up 0.8% here for the day. The Nasdaq 100 was actually down 0.1%. The IWM up 0.84% and extended hours up 0.33%. But the biggest winner here today was definitely the RSP, up 1.33%, and extended hours trade up 1.34% as well. Very, very upbeat action right here. Mid caps up about 1%, same with the SP 600. It was just an overall very bullish day across the board. We also saw S&P 500 market breadth improved markedly. Now, stocks above the 200-day moving average, there was no real issue here, but now sitting at 58%, very healthy. Stocks above the 50-day moving average has actually rebounded from Wednesday from below the 40 level to the 50.29 level. And, if we get another bullish day on Monday, this should be above the 55% mark. And then we'll have the long-term trend as well as the medium-term trend looking very, very favorable for the bulls. Now, stocks above the 20-day moving average still looking a bit sick, but again, a stark improvement from Wednesday at 45.32%. And, just one more day of very bullish momentum, this will be above 55%. And then it's off to the races. But market breadth improving, particularly the longer term and medium term trends right here. This is, what really matters in the market, especially as investors looking 12 months out. The medium and longer term trends matter more than the shorter term trends. But it certainly does help to have all three moving in the same direction. And they are. We formed a bottom and now it's onward and upward. Now, looking at other parts of the market, looking at the 10-year yield, we saw another big drop and it's actually now sitting at about the 4.5% level. This was the same level that we said if we do break out, we can actually have a bit of a problem. And it does look like that was a bit of a fake out here, but we still actually have to move below this line first, and we can actually find support and move up from here. But after the data we got this week, I do think that yields are probably going to push lower into next week, particularly early next week. Now, that did support bonds for the most part, but risk on assets weren't quite there. Bitcoin sort of still balancing at this 67,000 range, down 1.16% today. Gold actually lost as well, down 0.72%. Silver was down 2.53%. And in my personal opinion, silver really needs to, find a bottom right now and push its way back up to these highs, because if it breaks this $30 level, the next key level of support is really very close to the 26 mark right here. We saw crude down 1.18% today, even though the energy sector was the best performing sector. And I think there's just a bit of upbeat action with regards to the OPEC meeting this week. And then the dollar was actually down a 0.1%. Now, June has just wrapped up. The monthly candles are officially in, and this is the S&P 500 monthly candle. We are up 4.8% for the month. Bulls were getting all excited this week because of a little bit of selling pressure we saw here at the top. But when you zoom out, look at the monthly chart. This is bullish. This is the highest monthly close ever. That's an all-time closing monthly high. We also made a monthly wick high, very close to the 5,400 area. Insanely bullish stats. You can just, and on the monthly chart, the S&P 500, we are very clearly in an uptrend, and you don't really want to fight the trend at all. You can see that we did put in one red candle, but we paired almost all of those candles with a monthly bullish engulfing candle, and that probably warrants further upside. Not without volatility. Definitely will be getting volatility for sure, but more upside is definitely warranted. So let's say on a monthly chart, let's say we are to pull back, what level will we be looking at to find like support, and what level do I get bearish on? The very first level is just this level right here, the 47.86. We could pull all the way back to the 4700. The trend would still be up, find support right here, move, make all-time highs, and that would just be trend continuation. I will get bearish, however, if we do go ahead and break the 47.86 level. If we go ahead and break that, I think we're probably going to see very close to the 4200 level here in the S&P 500. But the 4700 area is about 10% away. And even if we do pull back, I do expect this to be a very strong support zone, simply because it was the all-time high in 2021. And we do know that resistance turns into support, and I do expect this to be a very strong support zone. But I actually do favor us just moving higher from here. And I don't think we're actually going to go ahead and take out the May lows. If we do actually get to this level right here, the 5,000 level, I think we'll find very strong support there as well. Now, diving into the weekly chart, so we can see a couple of glaring things. While the monthly chart does look bullish in the most recent candle, this week's candle not quite as bullish. We were down 0.51%, but there was a very big wick. It would have been ever more so bearish had we actually closed near the lows of the week, but that is simply not the case. Bulls came in a very big way here today, as you can see, up 0.8% in the S&P 500 after we put in this weekly doji candle. So things looking a little bit ominous on the weekly chart at the highs right here, but things are looking good on the monthly monthly, and in aggregate, all in all, you do have to understand that we are putting in higher lows on the weekly chart, and we are putting in higher highs and weekly all-time highs like we did just a couple of weeks ago. Now on the weekly chart, where does the trend begin to break down? I think it's this level right here, the 5,000 level. If we pull back to this 5,000 level, we're going to find strong support here, and then I think we're going to continue the trend. However, if we do break the 5,000 level, that would actually be a trend breakdown, and then we would actually go to the monthly support zone of 47.86. So that's what I see right there. So 5,000 is the key level that we need to hold here. And again, we're about 5.26% from that level breaking. Do I think we're going to get there? Probably not. It would take a number of weeks. It's not going to happen in a single week, especially with the bullish momentum we're seeing. But until we actually break this 5,000 level on the weekly chart and the 47.86 on the monthly chart, that's when I would get bearish on each of those charts. And all in all, you do have to look at it in aggregate. You know, we're very bullish on the monthly chart. We're very, very bullish on the weekly chart as well. Seeing a bit of volatility come in here, but we do have to dive deeper just to get a bit more nuance on the daily chart to see where we are. Now, you can see this is the monthly support zone right here. This is the weekly support zone right here. Now, what about the daily chart? Where does that leave us on the daily? Now, we've been in a daily downtrend since we made all-time highs here, middle of May. We've been in a daily downtrend ever since we made this bearish engulfing candle. We had 4 days of pretty solid downward momentum, and now we bounce back in a very, very big way. Look at this wick. I mean, it's sort of like the bears were caught off guard after we gapped up, couldn't break the day's highs, and then the bears took us all the way to the low here at 51.90. And then we put in a bottom. There was a flurry of buying action, and that took us above the day's open, above the day's highs, and even above yesterday's close. And we closed at the 52.77 area. Now back to the daily chart. This is a very, very bullish candle, and it probably sets the low that we want to look at next week. It's also a very critical level because it's above the 52.50 area, which has been the key level we've been looking at all week. So as long as we're above this 52.50 area, I think we're very, very bullish, and there's strong support here. We know that the bulls are going to come in a very big way here at the 5200 area and support price. And that's actually exactly what I said in my live stream. I said bulls are going to come in a very big way at the 5200 area, simply because the gamma put support zone was at the 5200. So we actually moved into negative gamma. We found support at the put support. Remember, these areas, the call gamma resistance and the put support, offer strong resistance and strong support for the market. If we do break above or break below, things get a bit dicey. That wasn't the case. We found support at the 5200 area, moved up in a very, very strong way, particularly after midday. And it does look like we're moving towards the gamma flip zone, which is at 52.95 still. So if we break above 52.95 next week, we're back into positive gamma. And this is the type of price action you can actually expect in negative gamma. You get huge moves to the downside and upside versus when we're in positive gamma right here, which you just buy dip, sell rips, and it's very compressed volatility. So very, very clear. You see negative gamma, positive gamma. So what am I looking at next week? Well, next week, I want to look to the 52.50 area. I think we're going to find support right here. I think we also find support at the 5200. Those are the two areas that if we do pull back on the daily chart, I want to look at and buy the dips. If we do break below 5250, I want to find support at 5200. And if we do break below 5200, we'll talk about that when we get there. But for now, 5250, find support. And then I want to see the 52.95 get into positive gamma and then all-time highs next week for the S&P 500. If we actually take a measured move from where we closed to where we are right now, we're 1.21% away from all-time highs. So guys, come Monday, we have the first trading day in June, and these are the expectations and returns we can actually expect on that first trading day. Now, seasonality isn't a crystal ball. It's simply a tool we can use to gauge probabilities, and the probability suggests for the Dow Jones that the first trading day of June is normally flat. On average, we can see median returns 0.17%, but most of the time we can actually see a positive June 1st, 72.4% of the time. Since 1995, we've had 21 up years, 8 down years. A little bit different here in the S&P 500. The 1st of June on average tends to be negative, median return 0.07%, and only 62% of the time is it higher. So we do get off to a rocky start in June here in the S&P 500, and since 1995, the S&P 500 has had 18 up years, 11 down years. But what seasonality and stats like this fail to consider is actually the fundamental aspect of stocks. And looking at overall earnings for the week, earnings season has pretty much just wrapped up and not much has changed at all. S&P 500 earnings is sitting at 8%, and on the revenue side sitting at 3.8%, beating expectations handily. But the more important story with regards to the fundamental picture actually has to do with profit margins. S&P 500 profit margins are nearing the pandemic high, and it's part of the reason why we're actually seeing the rally we have in stocks in 2024. Job cuts and lower input costs are shoring up profitability. You can see this is where we are in Q1 in 2024, and this is the expectation into the same quarter next year in 2025. Now, this graph was actually taken from this article, and I'm going to read it to you guys. It's very interesting with regards to the S&P 500 pricing power as well as profits being the highest in 16 years. Now, the S&P 500 companies are on track to be more profitable than they have been in over a decade, boosted by layoffs, lower commodity prices, and continued pricing power. The index's average net income margin is projected to surpass 13% in the second half of the year, according to analyst estimates compiled by Bloomberg Intelligence, and then continues to rise into next year to almost the best on record since 2009. For a while now, people have been making calls that profit margins will get squeezed, and we simply have not seen that, said Greg Taylor, Chief Investment Officer at Purpose Investments. Firms have largely opted not to pass on savings from falling commodity prices costs to further lower expenses, hence why profit margins are increasing. Many are also cutting their workforce and turning to artificial intelligence. We're still at an early innings of AI, and AI increasing productivity, said UBS Private Wealth Management Director Rod von Lipsey. Tech companies have outstripped the broader market index in terms of profitability. The so-called Magnificent Seven companies enjoyed an average profit margin of 24% in the first quarter, double the S&P 500's 12% average. Apple and Amazon have undertaken significant headcount reductions in recent months, reversing years of aggressive hiring. The sector's margin bonanza has spurred the likes of Alphabet and Meta platforms to issue their first dividend payment. Now that big tech has shown it can run lean and reap further margins, other companies may be pressured to follow suit. Aggressive cost cutting has already resulted in more firms reporting profitability above expectations than any time in the last 2 years. Among 481 S&P 500 companies that have reported this quarter, 72% net income margins that come in above analyst estimates. The extra cash is being redeployed to buy back shares. S&P 500 firms have announced share repurchases at the highest rate in almost 2 years, according to data compiled by Bloomberg. Completed buybacks are up 16% to the first quarter from the same period a year ago. Shareholders have responded by putting trillions into US equity, sending the S&P 500 about 28% higher since the October low. And there's nothing more I can say to that. Companies are making cash and they're delivering cash back to their shareholders, and that is why stocks are absolutely rallying. And Bloomberg expects this to continue into 2025. And like I always say, when you have a situation where earnings are increasing like they are and margins are increasing as they are, you want to own stocks, you want to own equities in an environment like that. Part of the reason why equities has rallied actually has to do with GDP. We got the latest GDP numbers yesterday, came in at 1.3%. We've actually seen GDP decelerate, but if we look at the last 4 quarters, GDP has been very, very robust. In some instances, well above 3% and the 2% figure here, which is on the upper end of what you want for GDP. I think anywhere from 2 to 4% is fairly healthy. We got 1.3%. Now, GDP has been decelerating, but it's not necessarily something to be worried about because the Fed's GDP Now figure currently sees GDP for the second quarter 2024 at 3.5%. So GDP is looking rather robust for this quarter, and that is supporting equities, earnings, and margins as a whole. So in an environment where GDP is decelerating but earnings are still growing, do we want to own equities? And if so, where do we want to be positioned? Now, the current regime we're in is GDP decelerating and EPS is growing, and that is often the best backdrop for stocks. You can see that occurs only about 11% of the time. Average return quarter over quarter, 3.6%, median 3.7%, with a hit rate of 78.8%. So even though GDP is decelerating, if EPS is growing, that's largely good. And a lot of the time, the reason why EPS grows more when economic growth is decelerating has to do with the fact that companies find operating leverage, there's expense control, cost control, and it just allows companies to be more efficient. Now, in an environment where GDP GDP is accelerating as well as EPS accelerating, as is the expectation for GDP in the second quarter being at 3.5%. We can actually expect average returns of 2%, median returns of 3%. We're in that environment about 33.7% of the time, and that happens about 68.7% of the time. And then you guys can go ahead and look at what happens when earnings decrease and GDP decreases versus GDP accelerating. These are the stats right here. Part of the reason why we're actually seeing GDP increase has to do with consumer spending. Consumption has remained largely robust, and this has to do with employee compensation as well as disposable income being above PCE inflation as a whole. This right here is the PCE index since 2020, and as you can see, when indexed to 100, employee compensation and disposable income has actually outpaced the rate of inflation. That has led to higher consumption. The US economy is largely a consumption-driven economy, and when you have consumers with more money, more disposable income, and making more money, you're going to get higher consumption, higher GDP growth, strong employment, and as a result, higher earnings, higher stock prices. Now, another measure of consumption that I like to look at is airport traffic. This right here is millions of passengers year over year. US airport traffic reached a record high over the Memorial Day weekend. Very interesting stats. This is 2019-2023 trends right here, and you can see consumers are traveling, whether it be for business, leisure, tourism, whatever it is. They're definitely traveling more, and this isn't just like a one-shot occurrence. This has actually been the case from January throughout May, and very likely will continue throughout 2024. And this right here is just a very interesting barometer for the consumer. Now, what about the rest of 2024, 2025? Now, this is Goldman Sachs' key economic market forecast, and you can see GDP growth right here, and Goldman Sachs expect GDP globally to be 2.7% at the end of the year, 2.8% for the US, and in 2025, 2.2% for the US, 2.8% globally. They expect interest rates at the end of 2024 to be 4.2. Interest rates right now are near the 4.6, 4.5 level. And having a look at consumption metrics, they expect CPI at the end of the year to be at 3.3% and then 2.7% in 2025 at the end of the year. And they expect the unemployment rate to actually fall from where it is right now. The unemployment rate is 3.9%. They expect the unemployment rate to fall to 3.8% in 24 and 3.7% in 2025. And it's also not necessarily on year, but they also expect PCE inflation to fall to 2.8% year over year by December 2024. So those are the market forecasts for Goldman Sachs. And pretty much what they expect is the unemployment rate to stay steady. They continue to see inflation decelerate and GDP to remain robust throughout 2024. And that's a healthy market environment and a market where you want to own equities. But if you've made it up until here, thank you so much for watching. If you like this video, please subscribe, hit the notification bell, like this video, and leave a comment for the algorithm. Cheers.